Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be talking about a relatively uninteresting topic in the way of bonds and CDs. This is something that I noted last year in February when we saw bonds begin to have a sharp tick upwards at that time, going to about the 120 basis point mark or 1.2%. And I highlighted that sometimes we would see tech decline on some of those large increases in the 10-year treasury or the 10-year bond yield, because that would be the time when people with a lot of money would be moving that money over into bonds to have some conservation of capital. I also highlighted that that was going on again at the end of last year and into January. What you're seeing here, though, is we've got the 10-year yield. It is trading around 175 basis points. If you look at the 10-year movement right here on the right-hand side of your screen, you can see that while we did stay under that 150 mark, we've relatively flatlined for the entire month of January. So we've stayed stock still that entire time. And the question is, where do you put your money right now? We've seen a lot of stocks that have dropped like a rock, including today, after hours, Facebook dropping more than 20%, and that is a FANG stock, so it's one of the big dogs. And the question is, what do we do with your money right now? We know that inflation, while it could be leveling out, we are still seeing massive CPI prints coming through. And if you're looking at putting your money into CDs or bonds, there's just not a lot of yield. And while it's nice to think that, hey, we can go and invest a ton of money into stocks, depending on what you're in, you may actually end up losing money over the same time period, versus here you'd at least get some cash and some change. So what I'm going to suggest, and this is something that a lot of financial planners and managers will encourage, is a split between stocks, cash, and bonds or yields. And you can see right here that we've got CDs that go out 3, 6, 9 months, as well as 1, 2, and 5+ years. And the yields there are relatively small. What I'm going to be looking to do over the course of these next few months is look to allocate a portion of my portfolio into 1-year bonds. And the reason for that is because I'd like to start building up a position of cash that I can use for other investments at a time that I think we're going to see a large drop in valuations, specifically in real estate. So what I'm going to be looking to do is make a sizable deposit into most likely AAA corporate bonds for the 1-year time period. You can see that that will get a 1.67% return on investment. And you can also see that during that same point of time, I should be able to match that up with CDs, which again, this is going to be cash that I would like to have access to, would like to use, but don't want to get that 0.01% in the bank account. So that means that after 3 months after this purchase right here, I can then invest in the 9-month CD, depending on rates at that time, which I expect to go up as interest rate environment continues to change, and then 6 months and 3 months. So that means that I will have this sum of money that I place here in the AAA corporate will be expiring 1 year from now, or at least 1 year from that investment. And I plan on lining up that with the deposit from the 9 months, 6 months, and 3 months. So while this is not the 10 to 20 to 30% return that we may have seen last year during that same time period, even just investing in the S&P 500, I will continue to have my equity allocations, but this will allow me to build a sizable cash balance that I will be able to use next spring in the anticipation of a very different real estate market than the one we see today. So this is one way that you can leverage a conservation of capital position while still having exposure to the markets via stocks and funds, of which I'll continue to talk about in other videos and in the Discord. So if you find this content helpful, please leave a like and subscribe. It really helps the channel to grow. Thanks for watching. Talk to you later. Bye.